Welcome to Retiring Well. We've got a great show lined up for you, just starting off with ROI. What is that? Return on investment. How does that apply? Have you ever considered investing in real estate or currently have real estate? You'll want to stay tuned for that information. Along with that, retirement planning myths that could cost you thousands. So be cautious of that. And then taxes for your beneficiaries. Have you considered what that looks like for the next generation? And then lastly, the top 3 retirement mistakes. You'll definitely want to be tuning in there. So stay tuned for all this and a whole lot more coming up right here, right now on Retiring Well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well. Plan to retire well.
Welcome to Coffee Talk. Here we are in this financial world of jargon, and we're going to throw out yet another acronym for you, ROI. What is that? What does it mean for you, especially as you're building your assets and then getting into retirement? So ROI, return on investment. All right, seems simple enough, but I know, Art, it may be a little more complex that people need to better understand.
Absolutely. You know, the number is, the term ROI, I think, gets thrown around a lot, and it gets used incorrectly in many cases. And also people don't really understand kind of how that rolls out in the various investment you have out there. So today we want to talk about it in different terms so you have an idea also, and we challenge you during this process too, is think of your investments, whether that's an actual investment in the market, whether that's a CD, whether that's a piece of land, whether that's a rental property or some asset you have. What is that return on investment that's giving you? Oftentimes people come in and they're maybe new to the rental world, or they've got into this, or they've had it for years and they've been loosely paying attention to this rental property. Hey, it's kicking out rent and it's doing great and I'm making so much money. But then when we start working through the numbers, we're finding out that they're at best breaking even in some cases because of expenses and stuff like that, but they're thinking it's a great investment.
Yeah, so true. So when you're looking at an investment, you want to best understand what your net profit is. So again, as Art's talking through, net profit is going to be all of the gains, but subtract out any of those costs that you have involved, and then divide that by what was your original investment cost. So again, real estate seems to be one of the more easier ones to understand here. So let's walk through a basic example here of, okay, let's assume you're collecting $2,500 a month of rent. So great, you've got $30,000 a year coming in, and let's say you purchased that property originally for $300,000. We're using for simple math for me here, Art. So yeah. So on that, initially you would think, hey, I'm making 10% a year on that original investment. What a great deal. Well, then again, you have to factor in those costs. So whether you have a mortgage, the different property taxes, insurance, are you paying for different utilities, the repairs on it, are there different association fees within there? So the list could probably go on of different costs, but let's, for illustrative sake, say that's $1,500 a month or $18,000 a year on this example. So you were collecting $30,000 of rent, seemed great, but now you've got $18,000 a year of costs. So now your net profit is $12,000 a year on that $300,000 investment. So now in all reality, you're looking at about a 4% annual return. And of course, with real estate, you hope there's appreciation going on within the property. And so you're going to get some hopeful added return over the long run when you go to sell that property. But again, some of those details that, as we have conversation, I think people sort of start to forget about all those costs involved.
Absolutely. And because they're almost either just used to them or they're not fully associating them. Another one that I hear a lot about is vacant raw land. Somebody owns a lot or some acreage somewhere and it's just sitting. Hey, I've had this, and they talk about how wonderful an investment it is and the return's phenomenal and all this sort of stuff, but they're not renting it. They're not like selling timber off of it. They're not farming it. It's literally just sitting there and they drive by and look at it once a year and call it good. And maybe they don't even have an expectation of selling this, but there's still carrying costs of that. There's property taxes. Maybe you're carrying some form of insurance on that from a liability standpoint, and all these various things like that. And again, thinking through that. And in the investment world, like when we're talking about specific investments, those have costs too, right? Those are, even if you're just going out and buying your own mutual fund, there's expense ratios and all this sort of stuff in that. So in theory, there's very few things that are free out there. Now, in some cases, I believe, like some form of insurance products, as an example, like as a fixed annuity, through an insurance company, some of those are available out there and there's not per se a fee. If it's a published 5% rate as an example, then you're going to get a net 5% return. A CD is another one. Again, watch for certain hidden fees and stuff like that. But in many cases, when we talk about ROI, there are some things out there. But really, again, challenging you as an investor to think through these and really see if this investment is truly as valuable as you think it is.
Yeah, so true. And on top of that, consider the tax implications. So again, there's so much to unwind from this, but we encourage you to give us a call. We'd be happy to sit down with you for a no cost, no obligation second opinion.
If you are nearing retirement or already retired, we invite you to an exciting and informative live event with a complimentary gourmet dinner to help you plan to retire well. There is no cost and no obligation, and dinner is on us. Information is power. Let us help you make educated financial decisions, such as understanding Social Security do's and don'ts. What year-end tax planning opportunities should you consider? Is your financial plan still on track? Alphabet soup with retirement plans. What should you be using? Asset location versus asset allocation. Which matters more? We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of Northern Michigan, with offices in Traverse City, Gaylord, Petoskey, Cadillac, and Manistee. Call 888-608-5825 or register online and choose the date and location that works best for you. Tuesday, September 9th at Boone's Long Lake Inn in Traverse City. Wednesday, September 10th at the Hampton Inn and Suites in Manistee. Wednesday, September 10th at the Perry Hotel in Petoskey. Tuesday, September 16th at Slate in Traverse City. Wednesday, September 17th at Treetops Hunters Grill in Gaylord. Or Wednesday, September 17th at Ferris State University in Big Rapids. The live event starts at 6:30 p.m. and is free to attend, with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well. After more than a decade of stock market growth, volatility jolted investors back to the harsh reality of occasional market pullbacks in the investing cycle. Download our free white paper, Navigating Market Volatility. It's all about perspective, for an in-depth analysis of historic lessons and time-tested investment strategies. Simply go to sen-wealth.com, scroll down and click the link Navigating Market Volatility. It's all about perspective to receive your free copy of this valuable and informative resource.
Whether you're thinking about retirement, already retired, or you're just starting to take your financial future seriously, you're in the right place. Now, in our Northern Michigan offices, we've sat down with individuals and families, and a lot of them have very similar half-truths or myths that they thought were very true. So I'm here to debunk some of those myths and try to help you save hundreds, if not thousands of dollars. So myth number one, I'll spend less in retirement. Now, let's be honest, we might be very excited about retirement because now we have time to travel, spend time with the grandkids, do whatever you need to do, like maybe a home renovation. So yes, you may not be commuting as much to work, or you might not be going out to lunch with your coworkers, but there's going to be other expenses that are going to eat up some of that. So don't underestimate the lifestyle that you might want to live, or maybe inflation, or even healthcare costs. So we recently had a client come into our Traverse City office, and he had a concern. He had a truck that was on its last leg, and he needed to replace that truck. And with interest rates being high, 7 to 9%, he was concerned whether I should take a loan out or if I should just pay for the truck altogether. Now, that is a concern that it could be unforeseen circumstances in that situation, and he came to us for help. So it would be nice to have a little extra money in that situation, right? We dive deeper into a lot of these topics on our YouTube channel, and feel free to go into our YouTube channel and utilize any of those free information that we give to you in the public. Myth number 2, I can just rely on Social Security. Now, Social Security is great, but it was not intended to completely replace your income. It was only designed to replace about 40% of your income, in fact. And it really matters when you take that income. So if you take it early in retirement, it could eat up about 30% of what you could have taken if you would have waited a little bit longer. So it's very important to sit down with a licensed professional on this, and they can really do a deep dive on what your needs are right now, and could save you a lot of money in the long run on developing a good plan for you. We offer a free consultation in any one of our Northern Michigan locations, so feel free to give us a call. We would love to sit down and talk to you about your concerns on any of those topics. And then the third myth is, all I need is my 401k, right? So the 401k is great, but if you were to keep it all the way to retirement, that's going to incur required minimum distribution. And if you utilize, if you come in and talk to us and utilize maybe talking about a Roth conversion, or talking about maybe a life insurance, or even annuities can help be more tax efficient, it will save you hundreds, if not thousands, in the long run. And then the fourth myth is, I can wait until I'm older to start planning. Now, that's a dangerous one, because compound interest can really add up if you were to start even now, for instance, because whether you're in your 20s, your 30s, your 40s, or your 50s, it really does matter, and it does add up when you start planning for retirement. Now, whether you are nearing retirement and you're still concerned about that, and you're just like, oh man, I didn't start early enough, we can still talk to you about some good diversification strategies that we can do for you to help make a little bit more money, tax efficiencies, stuff like that. So don't wait. Visit our YouTube channel if you don't have time to come into our office, or give us a call. And there's plenty of good information there that can help you stay informed. Retirement should be something to look forward to, not something that you stress about. So whether it be myths, half-truths, or assumptions, it can quickly eat up and sabotage some of your future. So it's very important, again, to get in and talk to a licensed professional on this.
Centennial Wealth Advisory is expanding, and we are excited to add a new office in Manistee to better serve our growing family of clients. Our new office is located in the historic Briney Building in the center of idyllic downtown Manistee. Whether you are an existing client or would like to meet for the first time for your free, no-obligation initial consultation, we look forward to welcoming you in our new office, or at any of our Northern Michigan locations in Traverse City, Gaylord, Petoskey, Cadillac, or Manistee.
What can Retirement Analyzer do for you? Retirement Analyzer is a software tool that can help you prepare today for your financial future. You've worked hard to save for your retirement, but as you near your retirement, you may have concerns. Have I positioned my retirement savings wisely? Have I saved enough for retirement, and will my savings last throughout my lifetime? What impact could inflation have on my future expenses? What if I suffer a long-term illness? Will I have enough money to cover my medical care expenses and still be able to meet my other financial obligations? Could changes in the income tax rates disrupt my retirement strategy? There's no need to be in the dark as you prepare for your retirement. Retirement Analyzer can help you find answers to all these questions and more. The first step is providing us with information on your financial assets, the type and current value of those assets, as well as your sources of income. Then, we work with you to identify your expected expenses in retirement. This will include a discussion of the lifestyle you envision in retirement, travel, a summer residence, whatever you dream your retirement will be. We'll input the information you provide us into the Retirement Analyzer, and in a very short time, we'll have reports that show us the percentage of assets currently in high-risk vehicles, as well as the percent in lower-risk products. Retirement Analyzer enables us to project your income from year to year in your retirement and see how long your retirement savings may last. As we change the conditions of the report, delaying your retirement date, including costs for long-term care, adjusting the expected tax rate, or adjusting your retirement strategies, we can see how changes in these variables may impact your income in retirement and the longevity of your retirement savings. Let the Retirement Analyzer help you test drive your retirement strategy today, because the time to discover the bumps in the road is not once your trip through retirement has begun. Contact our office today to schedule an appointment for your Retirement Analyzer review.
Living life isn't always easy. It puts up challenges and obstacles you'll have to overcome. There are responsibilities. You put in effort to provide and take care of your family, to save and invest, to balance work and life. Planning is the first step to succeeding. Plan to retire well.
The famous quote, "In this world, nothing can be said to be certain except death and taxes," is a quote from Benjamin Franklin. In today's episode, I'm going to discuss both death and taxes. Specifically, I'm going to address the tax implications for your beneficiaries once you die. As Benjamin Franklin said, two things are certain, and that is death and taxes. So we are all going to die, but are your beneficiaries going to pay taxes on the money you leave them? The discussion of taxes is a complex issue, and I will not be able to cover everything in this video today. The focus of this video will be on the most common types of assets left to beneficiaries and their tax implications. The most common assets we see left for beneficiaries are IRAs, Roth IRAs, brokerage accounts, bank accounts, and property. I'm going to walk through each of these in this video and describe the tax implications for your beneficiaries. It is important to note that the federal estate tax exemption for 2025 is $13.99 million per individual. So if your estate is valued below $13.99 million, you won't have to pay federal estate taxes. We'll start first by discussing IRAs, 401ks, 403bs, and any other types of pre-tax retirement accounts. These accounts, when inherited by your beneficiaries, the accounts will be set up as a beneficiary IRA. The withdrawals are taxed as ordinary income, and the beneficiary will have 10 years to completely liquidate the account. The second type of account we will discuss is a Roth IRA. When your beneficiaries inherit a Roth IRA, they will be able to pull the funds out tax-free. The money that was contributed to the Roth IRA was after tax, and the money coming out is tax-free to the person who set up the account originally, but also to their beneficiaries. The third type of account we're going to discuss is a brokerage account. In this type of account, you might be holding cash, stocks, bonds, mutual funds, a whole host of different types of investments. When you inherit a brokerage account, the cost basis is stepped up to the value of the holdings upon the death of the person who had that brokerage account. And so you will only owe taxes as a beneficiary if you sell those positions at a higher value than the stepped up basis that was calculated upon the death of that person. For example, if you had $200,000 you had invested into a brokerage account, and when you passed away, the value of those investments was $400,000, your beneficiary would get that stepped up value of $400,000 as their cost basis. Fourth type of account we're going to discuss are bank accounts, and this could include checkings or savings accounts. You'll receive the amount as a beneficiary that is in that account upon the person's death, and you would only pay tax on any interest gained after they passed away. The fifth and final most common type of asset is properties. So when you inherit a home, the cost basis is stepped up to the fair market value upon the homeowner's death. This means that you can sell the home at that fair market value and not pay tax. I just shared the most common types of investments we see clients leave their beneficiaries. While other types of investments are left to beneficiaries, these are the most common, and as you can tell from what I shared, they carry different tax liabilities for your beneficiaries. As I mentioned earlier, tax situations can be complicated, and that is why it's important to work with a trusted tax professional. Here at Centennial Wealth Advisory, we have a tax firm in-house. We help our clients navigate the ever-changing tax landscape to make sure they minimize their tax liability. We would be happy to meet with you and discuss your specific situation. I would highly recommend taking advantage of a no-cost and no-obligation meeting so that we can help make sure you are on the correct path with respect to your tax situation and your overall financial plan. You can follow all the information on the screen to call one of our offices, email us here at one of our offices. We have 5 offices in Northern Michigan, and we would be happy to sit down with you at any of them and meet with you, learn more about your situation, and allow you to ask questions and get your questions answered in a helpful way. That way we can help you plan to retire well.
If you are nearing retirement or already retired, we invite you to an exciting and informative live event with a complimentary gourmet dinner to help you plan to retire well. There is no cost and no obligation, and dinner is on us. Information is power. Let us help you make educated financial decisions, such as understanding Social Security do's and don'ts. What year-end tax planning opportunities should you consider? Is your financial plan still on track? Alphabet soup with retirement plans. What should you be using? Asset location versus asset allocation. Which matters more? We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of Northern Michigan, with offices in Traverse City, Gaylord, Petoskey, Cadillac, and Manistee. Call 888-608-5825 or register online and choose the date and location that works best for you. Tuesday, September 9th at Boone's Long Lake Inn in Traverse City. Wednesday, September 10th at the Hampton Inn and Suites in Manistee. Wednesday, September 10th at the Perry Hotel in Petoskey. Tuesday, September 16th at Slate in Traverse City. Wednesday, September 17th at Treetops Hunters Grill in Gaylord. Or Wednesday, September 17th at Vera State University in Big Rapids. The live event starts at 6:30 p.m. and is free to attend, with a complimentary gourmet dinner to follow. But seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well. After more than a decade of stock market growth, volatility jolted investors back to the harsh reality of occasional market pullbacks in the investing cycle. Download our free white paper, Navigating Market Volatility. It's all about perspective, for an in-depth analysis of historic lessons and time-tested investment strategies. Simply go to sen-wealth.com, scroll down and click the link Navigating Market Volatility. It's all about perspective to receive your free copy of this valuable and informative resource. If you like watching Retiring Well, make sure to go to youtube.com/retiringwell and click the subscribe button to never miss any of our TV shows and other informative videos.
All right, let's walk through the top 3 retirement mistakes that could significantly impact your financial security and quality of life in retirement. So let's start right off with underestimating how long you'll live. I think this can be so important when you're trying to map out a long-term plan, is to try and predict, well, how long are you going to live? None of us know exactly what that looks like, but too often people will say, well, I know my mom lived to this age, dad lived to that age, and they just assume, well, that's how long I'll live. Well, you have to consider what was their health in comparison to maybe where you are currently and what that looks like, although that can never predict exactly how long you're going to live. But you know, why does that matter? Ultimately, because you don't want to run out of money. You want to make sure that you've built a plan that supports you for the remainder of your lifetime. So if you assume, well, I'm only going to need income until I reach age 80, Well, if you live into your 90s or longer, like we're seeing a lot of folks, then that plan won't work well for you. So plan for, typically a lot of times it's at least 30 years of retirement income. So consider that maybe there's different types of accounts out there that'll provide income streams for you, whether you're looking at different insurance companies for that, or whether you're looking at with Social Security. Potentially, do you want to delay drawing your Social Security benefits to see if those will increase a bit further, delaying retirement, pushing that out a bit further to ensure that you have sufficient income stream when it gets to throughout your retirement years. Number two, not accounting for healthcare costs. I think so often people get to retirement, they're excited about that idea of, okay, now I can retire, but they haven't looked into the details of, well, what are the costs of retirement? And one of those big costs is healthcare. And so if you're prior to age 65, going out and shopping around on the marketplace to see what are the costs of the different types of policies that are available. And with that, there's different types of health insurance subsidies potentially based on your income. So if you're in a position where you can receive these health insurance subsidies, it'll reduce the costs of your monthly plan. And then beyond that, you get to age 65 and now you're into Medicare and evaluating the different options that are out there for whether supplemental plans, advantage plans, you can start looking into that. And that's something that our team here at Centennial Wealth Advisory, we have specific insurance agents that are able to sit down with you and evaluate what those potential costs look like so that you can be well prepared for your retirement plan. And then the third big retirement mistake is withdrawing too much too soon. What do I mean by that? Let's say you get to retirement and it's been your dream to travel across America. And so you think, well, okay, I'm going to go out and buy that RV and start traveling. And you start to look at that and find out, well, that's going to potentially cost you in the, say, six-figure mark, and all of your assets, let's assume, are in retirement plans, 401ks, IRAs, etc. And so any dollar you pull out of those retirement plans is going to be taxable. So with that, you want to be very cautious, potentially not drawing all that money out too soon to pay for the RV or the different toys, the fishing boat, the truck, the whatever that comes up, because all of a sudden now you've liquidated a bulk of your nest egg that was meant to be there for that retirement income stream that I talked about earlier. So you want to be cautious about how you draw money out of the portfolio, and that's where taxes become a major factor in how to structure your retirement income. And that's something, again, our team focuses on a lot. We have a tax team that works in partnership with the investment advisory team when clients are trying to set up a long-term plan to generate income. We need to put our heads together and figure out, okay, where's the best place to draw money from in order to keep as much money in your pockets versus Uncle Sam. So if you're in a situation where you don't want to make any of these retirement mistakes, thankfully, we've got a team here at Centennial Wealth Advisory that's ready to serve you and help you plan to retire well.